What is new and interesting at Ashford? Tell me the latest and the greatest for you guys.
Well, there's a handful of things going on. I think, overall, on the, let's say, positive side, numbers continue to get better. Our hotels are, as you all know, are well diversified across the U.S., kind of a mix of business and leisure travel, mix of group. They're pretty evenly balanced. So numbers are pretty much back. They're a
Mm-hmm.
little bit higher than they were in 2019 on a revenue side. They're a little bit under 2019 on a EBITDA side. We still got a
Mm-hmm.
little bit of margin, 100 to 200 basis points of margin erosion because of mostly labor costs. Um, and we're not really seeing any softness. I
Mm-hmm.
think things are still growing, and the only kind of little pockets that we see that are pulling back are places like Key West, which was just so crazy on fire that's finally kind of settled down a little bit. But really, that's about it. I mean, at least for us, I know some of my peers that have luxury assets, are seeing a little bit of softening in some of their really high end markets, but um, I think that's mostly just because Europe's opening up, and
Mm-hmm.
like I'm leaving for Rome in a few weeks with some of my children. Because the first time I've been back to Europe in 5 years,
Mm-hmm.
so I think there's a lot of people doing that. Um, so that's good. We're still dealing. We're kind of finally chopping some wood on some of these on the loans. I mean, what keeps me up at night is really less on the operational side. It's really more in the capital markets
Yeah.
because they are a mess.
Yeah. I
I
think
mean,
most people
they're
will agree with that assessment. Yeah.
they are just a mess. And so we managed to get two assets refinanced this in the last couple months. It was basically $100 million loan on two assets: our Hilton Alexandria in Old Town Alexandria, and our La Posada asset in Santa Fe.
Yeah. I wanted to ask you about that. What was it like refinancing right now? I imagine it wasn't a fun experience.
Well, that one was fun. Actually, that one was the exception.
Mm-hmm.
You know, that was one where we have a really good lender, a relationship lender. It's a German bank that had the Alexandria loan, and Alexandria is not all the way back. Um, and so it probably needed a pay down if we were going to do an extension on that loan.
Mm-hmm.
And then, but La Posada was also a single asset financing, and it had tons of. It was very, very, very low leverage. So we just ended up going to the lender on Alexander and say, hey, if we throw this asset into the collateral package, can we just refinance them both at the same time? And they said,
Mm-hmm.
yeah, we love that asset.
Mm-hmm.
So they, negotiated very solid terms. I probably had at least a dozen of my, peers and hotel industry colleagues call me up and go, "How did you get the terms on that loan?" Because they were very, very good terms.
Mm-hmm.
But it's just a good, good assets with a good relationship lender, and that was easy.
Yeah. So that was
Um, the
SOFR plus
more,
four, right?
yeah,
Okay.
it was, which is still more expensive than you would like.
Mm-hmm.
But I mean, spreads have not compressed as we wish they would, but
Mm-hmm.
relative to alternatives, it was pretty good pricing. Um, but where I'm spending a lot of my time is just negotiating and dealing with a lot of loan extensions. We've
Mm-hmm.
got a ton of loans that have extensions this year that have debt yield tests. So we've had a $400 million loan that we did earlier this year, where we did basically a $50 million pay down. And then we had almost $1 billion loan that we had after that, which was about $100 million pay down. And then we've got basically another $1.2 billion of loans that are happening right now that we're currently negotiating. Um, those require some, level of pay down, still TBD. Um, so it's busy on that front, trying
Mm-hmm.
to get the capital structure where it needs to be. But we're making good progress, and um, paying things down, and I think making our debt balances slowly but surely more sustainable.
So,
Um,
do you feel confident you're going to get that all done? Is there any possibility that any of that's going to be handed back keys or anything?
it's possible. I think, I mean, this one pool that the ones that we're working on right now, it actually has 6 different pools of assets.
Hmm.
Each one's about $200 million. And yes, there are some pools within that are struggling.
Hmm.
And so then the question is, do you just hand them back? But which we have before. We handed back
Yeah.
15 assets during COVID. So
The
we'll
biggest
do
one
that if
was what,
we
the Embassy Suites in New York, right? That was the big
that
one.
that was one that we did. But so anyway, it really depends on. But at the same time, it's a CMBS loan, but we
Hmm.
know who the controlling holder is, and they're and very involved in the hotel business, so they're kind of good partners on that front. And
Hmm.
so the question is if some of these pools are a little bit underwater, we'll put money in, but it's got to be restructured.
Hmm.
And so what are they open to? And so that's it's complicated
Yeah.
when you've got kind of 6 pools negotiating at the same time. Um, but that's what we're working on. Our goal is trying to, if we're going to invest in pools, it's because we like where we are in that capital structure, and and we think there's equity in the pools. So
Hmm.
so we'll see what comes of that.
Is there any sense of like, kick the can down the road a little bit and see where we're at in 24, 25, or is there kind of no more patience for that sort of thinking? Like where,
No, I think there's patience. I mean, I think you're now we're re-entering given where the capital markets are.
hmm,
I think your lenders are still loath to take back assets if they don't have to.
hmm,
And because most of the assets that are being taken back, I mean, what's so interesting about this time period is just I've never seen markets so like a distribution so wide in terms of how markets are performing, right? I mean, you have Park
hmm,
handing back their 2 assets in San Francisco, which didn't surprise me whatsoever because every asset we own in San Francisco is down 20 to 40% versus where it was pre-COVID. Um,
at the
and
same
so
time,
what's
park
happening is that
at
what's
the
that?
same time, I feel like the park folks are probably still more bullish on San Francisco than you are. That's just my sense.
That
Which is,
may be. I mean, I've got a ton of assets. I would love for San Francisco to come back.
hmm,
It's ugly.
yeah,
It's just because the issues are deep. I mean, this isn't
hmm,
just like we just need the economy to come back. This is a structural issue about crime and homelessness and the future of office space and the future of the technology industry. I mean, there's a lot of really interesting overlaps onto how that might work.
hmm,
I don't know. I mean, maybe they eventually get a mayor that's like Rudy Giuliani and just starts cracking skulls and cleaning up the city. I mean, that would probably be a good step one.
hmm.
But
I think
and I
they'd
know their new
opt
mayor
for
is
Chinese
what's
travelers
that?
before. I said I think they'd probably opt for the Chinese traveler to come back before anything else, right?
Yeah, that would be nice. Um, but but I think the issue is that the assets of which are most likely to be handed back are in like 10 markets. It's going to be
Yeah.
San Fran, Portland, Seattle, Minneapolis, Chicago, Philly, maybe some of the Rust Belt. I don't know about Pittsburgh and Cleveland and, some of the kind of Rust Belt areas.
Hmm.
But
And be careful
because
what you
so much
say
of the
about
other,
the Rust Belt. You got to be
I
careful.
know I have a big heart for the Rust Belt people, but,
Hmm.
those cities are struggling.
Oh yeah. Well, that's
Um,
that's basically post-industrial America. The Rust Belt is
yeah,
struggling. Like.
that's right. And COVID, kind of threw some gasoline on that.
Hmm.
Um, and so you have these weird things where you've got those markets where, they're down 20, 30, 40%. And um, Nashville and Dallas and Tampa and Charleston and Savannah and Phoenix are all doing great. So
Hmm.
it, so the assets of which you would be willing to hand back are assets where people have real concerns. So I'm not sure people are clamoring for taking back assets in Minneapolis right now.
Yeah. Have you ever experienced the market just like this fragmented? I mean, like you're saying,
Yeah.
operations overall pretty good. Capital side is a mess, but then yeah, if you drill into like market by market, it's so all over the place, right? You don't know whether to feel good or
It's
bad.
it's unlike I was talking to somebody about this the other day. If you had given me kind of the distribution of returns of all of the markets, and you'd handed this to me 5 years ago and said, hey, 5 years in the future, this is what these hotel markets are going to look like. There is no way you could have made sense of it. Like, why is Nashville up 30% and San Francisco down 30? Like, how could you explain that? Why is Chicago, down 15, but Tampa's up 30? I mean, you have no idea why that is. So, and I think that's also something that we have to all think about when we talk about recessions, is that I'm not sure a recession really moves the needle here. For example, in Dallas, there's kind of too much going on. I mean, there's too many people moving here. There's too much business coming here. I mean, we may feel it a little bit, but versus, a recession may hit Minneapolis harder. So I think when we talk about what might happen in the economy, I think I don't see why it may not be kind of distributed in the same way that we're seeing numbers on the ground.
Has the current environment kind of shifted how you think about recessions? And I bring that in the context, like we were already talking about San Francisco, and obviously the tech recession is a very real thing and has a very real impact on that market. Has that changed? Like, you look at a market like Dallas or other big business-driven markets, like there's no one industry that's going to kill it. I mean, maybe it's like oil in Houston or something because we saw that a few years ago. But does that change your overall look at, like, all right, a recession will do this and this market will react this way?
Yeah, I think so. And I think what we are very focused on, both in kind of reevaluating our own portfolio over time and in reevaluating, and evaluating acquisitions going forward, is I think we got to experience the value of at least substantive multiple demand sources when you have an asset. And like the example I'll give you is like we have this, I don't know if you've been to our Renaissance in Nashville, but it's right on.
I have stayed at that hotel. It was the very first hotel I stayed at as an employee of H&N, was the Renaissance Nashville.
Really?
Trivia
And
for the day.
what year was that?
Oh, it would have been 2015.
Okay, so we had owned the asset because we bought it. We had it in 2010, but we hadn't renovated it yet. So, because we renovated it in kind of 18. But if you went there now, I mean, that hotel's unbelievable. It'll do $35 million of EBITDA this year. But that hotel is 700 rooms. It's giant. And everything's shut down, right? I mean, the whole city shuts down, meetings shut down. It's got, 80,000 square feet of meeting space. But that hotel was able to bounce back because it also had a ton of leisure demand. And so the strength of that hotel is that it can remix itself in terms of groups, big group, small group. It's got every bachelorette party in the world that goes to Nashville stays at that hotel. Yeah. They can drag themselves back off of Broadway.
Well, there's plenty of those to go around, to be fair.
Yeah. But you got to see, like, it could remix itself. And I think as we are looking at the types of hotels that we want to have in our portfolio, I think you genuinely want to have this ability to not be reliant upon one thing, which is what makes something like Houston very hard. I mean, Houston is a very difficult hotel market because it is great and then it is a disaster, back and forth and back and forth and back and forth. And I think San Francisco has a little bit of that problem now. And the question is, can it remix? I mean, are there other kind of industries and businesses and things that can come in? Because like Dallas has done that really well. And I think Miami's doing that well. And, Nashville's doing that well, where you're trying to pull from different demand sources. So, anyway, it definitely makes us rethink the way that we, how do we want to play demand when we're going into a market?
Yeah. And at the risk of sounding a little too much like Tyler Morse here, I just do wonder, like, whether this environment is the one that differentiates the people who kind of just rode the wave to the actual smart investors. Like, do you get the sense, like, you got to dig a little bit harder to find the right opportunities now?
Yeah, no, I mean, I think, well, and the removal of cheap financing, moves the kind of changes the state of play, right? I mean,
Yeah.
if you can buy almost any piece of real estate and finance it with 3 or 4% money, you can make some money on it. Um, I'm not saying that we're going to be necessarily at high interest rates forever. I think eventually rates will come down and it'll be a little bit more normalized. But cost of debt at 7% is you've got to figure out how to create value in a different way than you can if you're financing it at 3 or 4. So yeah, I do think it will over time really focus on those people who are and it's interesting because it's different businesses. I mean, there's the operational side, like
Hmm.
really squeezing dollars out day in and day out on the ops, and then there's the kind of strategic repositioning, thinking about the acquisition itself, what's the right brand, what's the right amenities, um, and hopefully those integrate. But those are you have great idea people. People go, man, if I could do this thing in that market, that would go well, and they might be right. But then there's that whole other expertise of, are you manning it? Do you have the right management structure within it? Do you have the
Yeah.
right the right people? So I do. I probably agree with that sentiment.
So, how do you feel about the future of Ashford now versus a couple of years ago? Because I know you guys have been kind of through it, and there's been a lot of work putting into kind of reimagining your structure and just getting through the worst of things. Because you guys were a little bit up against it at probably the worst possible time. So, how do you feel about the work you guys have done over the last couple of years, and what do you see as on the horizon for you guys?
Sure. Yeah. No. I mean, I think we've made a lot of progress. I mean, forthrightly, less than I would have liked. I mean, I think
Mm-hmm.
the capital markets, the change of them over the last year or so definitely has been a headwind where I would have liked to have made some more progress on delevering a little bit more, raising some more capital, paying off our friends at Oak Tree on that strategic financing, trying to get a path back to getting our common dividend back turned on.
Mm-hmm.
But so, and that's just reality, right? That's what you deal with day in, day out. So I haven't made as much progress on that as I would have liked, but I do think things are going in the right direction. And I think the part that is maybe most materially different for us is just the fact that we're now taking our capital raising into our own hands
Mm-hmm.
with Ashford Securities. Um, that's what Braemar raised almost $500 million through that platform. Bought the Four Seasons, in Scottsdale with cash. That's a nice
Mm-hmm.
feeling. Um,
You a little jealous?
yeah, that was nice. Richard's buying $260 million assets with cash.
Mm-hmm.
Um, bought the Dorado Beach, Ritz. And so for us, we probably aren't going to be going on a big acquisition spree initially as we raise this money. We've raised about $35 million so far from it, and we'll continue to do so. But it will help me, pay off debt, pay down debt as we do refinancings, and then eventually pivot to going on offense a little bit more. But having that fundraising capabilities kind of in our own power is, I think, really, really crucial because the public markets have changed. I actually, some of us were in some sense almost amazed at what Gaylord did with their common stock offering for the San Antonio deal that they
Mm-hmm.
did, because that's the way it used to be done.
Mm-hmm.
You would go get a deal, go talk to all the shareholders, go do a roadshow, go do an equity raise over 3 days. That was what it was like 15 years ago. And I was trying to think, when was the last time I actually saw one of our peers do that,
Mm-hmm.
of just like buy a deal the normal way? And the answer is, it's like I couldn't come up with it. It has to be at least, I don't know, 7 or 8 years.
Yeah.
And that's because our NAVs across the industry have been trading like garbage, and across the lodging REIT world. We've seen the rise of all of the kind of the quant and the passive sort of investors, where you're mostly just talking to algorithms now.
Mm-hmm.
And so you don't have relationships with the portfolio managers the same way. You can't really tell the story the same way.
Mm-hmm.
You can't get buy-in the same way. And so I think there's some very structural problems that exist in the public markets not just with lodging REITs, but I think it's highlighted in lodging REITs.
Yeah.
And so the question is, well, what do you do? And one is, well, I guess you just invest in your own assets is one answer. You sell them off when you can get good value, and you reinvest in your own assets, and I guess look at each other for a while. The other alternative that we want is like, well, what can we do to take that into our own hands? And if the public markets are there and are available, great. And if not, we still see opportunity and we want to take advantage of it. So of all the things that I think I'm most excited about is that, because I think you just want to control the ability to raise capital.
So let me ask you the philosophical question that comes out of that then. So if every lodging REIT, every publicly traded lodging REIT is consistently trading at a material discount to NAV,
Yep.
should they exist? Like, should lodging REITs exist if that's
a
the
good question? Yeah. I mean, the answer is I don't know. I guess in some ways the market is currently telling you that they shouldn't. And, some of it is just, back in the day, I think the stat that I was trying to remember was, I think when I was started in this business, or at least maybe go back 15 years, lodging REITs as a percentage of the REIT index were something like, I don't know, 15% of it. I don't know. I mean, we were still the kind of bastard child of the industry versus office REITs and mall REITs and retail REITs and multifamily and whatnot. But we at least were on people's radar. But now with the rise of, in particularly like data towers and some of these other industry types, we're now like 1% or 2% of the REIT index. So we're a rounding error, and we are merely, I think we are used basically as alpha that portfolio managers occasionally pick hotels in order, very kind of off and on, in order to kind of get a little bit of outperformance versus the market. But they don't have to own us all the time and kind of perform versus the market. So I don't know. I don't know if there's a place for hotels unless unless you get some either significant consolidation or you really let us grow. Like, we're just all at sizes too small. I mean, the industry is big. There's hotels everywhere. But what the institutions tell us are kind of investable hotels, are obviously a smaller subset of that. So I don't know. I think there are some interesting philosophical questions on what is the future of publicly traded lodging REITs, because at least as of now, the market's telling us we're a waste of time.
Well, that's uplifting, right?
Yeah, well, I'll let you know what I think about it.